Hello, everyone. Welcome to the Julius Baer podcast. This is Richard Tang, the China strategist and head of research Hong Kong for Bank Julius Baer. We just got into the new year, 2026, and it's great to have Hao with us again to discuss the outlook for the Chinese market. Hao is a renowned economist, and he's also the managing partner and CIO of Lotus Asset Management. Hi, Hao. Thank you very much for the time speaking with us today.
Hey, Richard. Happy New Year.
Hao, before we dive into the China market, let's first talk about the recent moves of the US President Donald Trump. He's been making some pretty bold moves lately, I would say. And as we know, his decisions tend to really have a lot of influence on many countries in the world. And now with this whole Greenland situation, he's suddenly threatening to slap new tariffs on the EU countries. And he even mentioned a 200 tariff on French champagne. So the big question is, how should we look at all this? Is it just an example of the Trump's negotiation tactics, which is first, he always started with maximum pressure to get what he wants, and then there may be some concessions in between? Or does it feel a little bit different to you this time?
I think it's quite different this time. Obviously, Greenland is rich in resource, especially in rare earths and also in some other forms of traditional energy that is probably required for AI development in the future. So I think the US is very serious about snatching the Greenland territory. Scott Bessent, he has a very good credibility with the market. He actually come out and say, wow, we're serious about buying Greenland and become part of the US territory. So I think right now, what Trump is trying to do is becoming clearer because last year imposing exorbitant tariff on European trading partners to shake them up so that he raised the initial price very high. So then as the negotiation goes on, he will raise more and more demands. But then this demands seems to be a little bit better than the original price. And therefore, in the negotiation process, you aim very high, but then offer a relatively low price as you go on. It tends to make the deal easier to be agreed. So I think right now, because there's a very long history of the Greenland and the complicated relationship of Greenland and the US, so I would say that this is not the first time the US trying to snatch Greenland from Denmark. And let's hope that it's not the last time. So basically means the US won't be successful this time to infringe on other sovereign territory.
These are very interesting comments indeed. And right now, as we speak to investors, it looks like the opinions are very divergent. At Julius Baer, we tend to think that this is a tricky moment for Trump to raise tariffs, especially in the midterm election year, because we note that his approval ratings actually have been sliding. And one of this reason is clearly that so far he has failed to solve the problem of high living costs for the Americans. So why would he want to impose tariffs to make the prices even higher? But of course, there are also investors who are telling us the completely opposite, that he thinks this time the entire issue is serious. In any case, if we look beyond the politics, I think for investors, the more important question, how does that affect global assets? Because as we can see from the past few days of actions, definitely the gold prices have gone through the roof. And some analysts think that it could strengthen the momentum for this shiny metal even more. And at the same time, it could further weaken the dollar. How would you agree to that view?
Yeah, well, I think, as investors, we're probably more interested in how the market is going to price in this kind of uncertainties. I think in my view, no matter Trump is successful or not snatching the Greenland territory, I think it's still beneficial to the precious metals price and also non-ferrous metals price. The reason being, if he's not successful, but then people know that he's going to have next step planned already. He knows that this is a very risky move, and also he's risking the alliance between US and Europe, an alliance that is more than 100 years old. He's playing a very high-stake game, and I think if he's not successful, then he will plan other things, trying to get the resources that he needs. So this is the core of his strategy. So if he doesn't get it from Greenland, he's going to get it from somewhere else. Now, if the US is not successful snaring Greenland from Denmark, then uncertainties would actually increase further from here because he's planning the next move, but nobody knows what he has in his pocket. In that case, then it's even more stimulating for precious metals and other metals. Now, if he is successful getting what he wants and getting all the resources and minerals, Now, the thing is that he probably would encounter very strong counteroffense from the European partners. So already, I think the European countries, relevant countries, actually grouping together, thinking of ways to deal with Trump's threat. For example, they're thinking of dumping the US dollar assets and all that, which amount to 10 trillion US dollars or more being held in European institutions. So if that's the case, then just imagine, right? So there will be chaos in financial markets, and therefore uncertainties will surge, and therefore precious metals price will surge as well. So I think whichever scenario you look at, I think it's just beneficiary to precious metal. And that's the reason why we're seeing gold and silver and other precious metals having an epic run in recent days. Now, I think as regard to the US dollar, I think we had already shared as well with our clients. Now, basically, we think the US dollar has entered a depreciation phase of the US dollar cycle. A US dollar cycle lasts for about 17 years. Now, in that 17 years, the first 10 years or so, the US dollar exchange rate rise up, and then the last 10 years, it comes down. So I think, the US is actually sort of starting the depreciating phase of the US dollar cycle, right? So the last 7 years of the 17-year cycle. So I think more likely than not, we're going to see US dollar continue to decline. Now, specifically, if you look at the trading situation last night, the US tech stocks tanked more than 2% last night in a day, basically wiped out all the gains that they was able to make since the beginning of the year. So even so, you're seeing long bond yields actually surging, and also the US dollar weakened as well. So you're seeing all the US dollar assets being sold off last night. Now, what that means is that investors are seeing US dollar assets as a risk in their portfolio, and they're going to continue to do this de-dollarization process and reallocate some of the dollar assets money into other parts of the world. For example, emerging market has been performing well. European is actually not weak, and also precious metal and the materials are doing exceedingly well this year. And also, despite a very severe sell-off last year, today in Asia market, in mainland Asia and also in Hong Kong, stocks has been quite resilient. We open lower, but then quickly we reverse all the losses, and now we're actually up, right? So what that means is that you're seeing money is starting to rotate out of the US market and going to Asia, in particular Chinese-related assets. And I think, this process will likely to continue for the rest of the year.
How you mentioned something really interesting, which is that traditionally when the US market went down, usually will have a negative ripple effect into the Asian hours, the Asian markets. But as you mentioned, this time the Chinese market is very resilient. So I just can't help by thinking that the Chinese market may be actually a beneficiary of market being reallocated out of the US. And as they find destination to park the money, China may benefit from that. But obviously, China has its own arguments and has its own focus. If we come back to China itself, I think it's fair to say that after some short period of consolidation last year, we're now seeing both A-shares and Hong Kong stocks going up again. And this time, it's very clear that A-shares are a little bit stronger. And we're also seeing some rotations of different investment themes. I think 2 weeks ago in Hong Kong and Shanghai, we discussed the commercial aerospace in the beginning of this year, which had done pretty well. We also note that several Chinese end market indicators are picking up. For example, the market turnover and the margin financing balances have both increased meaningfully. And maybe because of that, regulators have recently taken some action, including raising the margin financing requirements. So here is my question to you, Hao. Should we be worried about these moves? Because you may also recall that the market crash in 2015, which is 10 years ago, also began with the tightening of margin financing. Do you think the two situations are similar, or you think they are entirely different?
I think it's quite different. We're still in the early stage of this bull market, right? So I think stock has been doing rather well in recent weeks. We're up to 4,200 for the Shanghai Composite. The market rally right into the open of this year, and people has been doing exceedingly well. So I think the regulators probably trying to calm down the market, because the regulators keep saying that it wants a slow bull market. Now, the paradox of such official statement is that if you really want a slow bull market, let's say you want the market continue to rise in the next 3 years, if I were an investor, I know that you as a regulator try to make the market continue to rise for the next few years, then I'll buy now. So the more you say, I want a slow bull market, the more likely you're going to end up with a crazy rally right now, because everybody knows that you're trying to engineer a slow bull, and therefore I'm going to game you and I'm going to front run you before you can actually move. So I think that is actually one of the reasons why we're seeing the market rally out of the gate beginning of the year. Secondly, I think even though margin financing balance is at all-time high, but the market size now is entirely different from what it was 10 years ago. So 10 years ago, I think the market cap of Chinese stocks is probably not even half of what it is now, even at the peak of its index peak 10 years ago. Its market cap is probably less than half of the 130 trillion yuan market cap that we're seeing right now. So if you compare the outstanding margin financing balance to the total market cap, then I would say that the leverage ratio is actually relatively low, substantially lower than 10 years ago. And also, if you notice what the regulator is trying to do is deleverage in an orderly manner. So 10 years ago, it just happened that I was right in the middle of the action 10 years ago. I was lauded as the man who called the bubble burst because I published a report on the day of the bubble burst saying the bubble is going to burst. So what happened was that 10 years ago, we're actually trying to deleverage without much notice to the market. So we basically literally, brutally, violently, forcefully deleverage the market. So when that happened, because the market is starting to plunge, then people has to meet the market margin call. And back then, because the leverage was so high and people leverage up to their eyeballs, and therefore they had to sell down their stock portfolio to meet margin calls. And sometimes the Chinese brokers had to liquidate their investment portfolio so as to meet the margin call. So there was a disorderly deleveraging process. It came all out of the blue and nobody was prepared for it. Now, this time it's entirely different. The regulator is doing it at a measured pace, and also with the help of the national team, they are selling down some of the portfolio as well. And so I think the regulator is going to get a handle of the market's crazy rally in the first few weeks. And I think once the market calms down, then we'll come up with all sorts of supportive policy for the economy. So then the market will resume its upward trend. So I think for now, it's not comparable with 2015. And I think the regulator is doing something right this time because it's trying to deleverage orderly. But then since the regulator is looking for a slow bull market, and therefore, I think more likely than not, in the near term, you will see the market start to rally again.
Fair enough. And let's just hope that eventually we indeed get a slow bull in A share side. For the Hong Kong market, though, obviously the market is not watching so much about policy changes. But for now, I think the focus, laser focus, I would say, is to see how the IPO activity might have influenced the market momentum. We've done some historical study before. It doesn't look like there's any clear evidence or clear relationship between the IPO amount and the subsequent returns. But psychologically, that has always been one of the factors that people worry about if they want to worry about something. And Hong Kong raised close to 300 billion Hong Kong dollars through IPOs last year. And especially after the listings in December, we can now buy Hong Kong listed stocks of Chinese GPU and also AI model companies and many companies that are in the technology sector. The only thing is that some of these companies that get listed are not even profitable. But in any case, my question to Hao is, are we having too many listings now? And should we be concerned that if we have heavy IPO pipeline, will that drag down the market performance in Hong Kong?
Yeah, I think towards the fourth quarter last year, the rally of the Hong Kong market actually slowed down. Some people attribute it to lots of Chinese companies going IPO in Hong Kong. I think these days, the IPO market is really heated. If you want to ring the gong in the Hong Kong Stock Exchange, you have to line up in the queue because every day we have 3-4 companies or even more sometimes get listed in the Hong Kong Stock Exchange. So I think it's good and bad. It's good that normally during a bull market, you see a lot more IPO because this time of the year, many of the companies will want to list itself to sell for a higher price. But then that's a bull market behavior. It's a feature of the bull market. But at the same time, because of the liquidity diversion, much of the liquidity is being locked up in the IPO lottery. Nowadays, the lottery winning ratio is so low that when a good company coming for IPO, then it will lock up a trillion Hong Kong dollars of liquidity in the banking account. So I think it's a typical bull market characteristic, but then at the same time, it does diverge some of the liquidity in the market into the IPO process rather than use it for the secondary market. I think all in all, the benefits of such heavy IPO volume must have outweighed the drawbacks. If you look at the Hong Kong financial industry, last year, we're actually seeing many of the big iBanks, even the small iBanks, are actually recruiting for new hires. It hasn't happened for a long time. So even some of the smaller Chinese brokers in the city is recruiting as well, and they had a good year last year. And this year, the money-making process seems to be continuing. And I heard that bankers are getting record bonus again this year. If so, then I would say that the IPO is actually helping the city's economy as well, so that people's consumption money would increase, and therefore there will be more economic growth from retail. So I think the benefits from IPOs must have outweighed the drawbacks. And so therefore, I would say that IPO in general is good for the Hong Kong economy and the market.
Fair enough. And the way I would think about it is similar, in which, yes, if there are too many IPO companies, then it could drain the liquidity. But as we just discussed, a lot of money are now coming into Hong Kong from US or somewhere else. So hopefully that would be well absorbed. And also from a market structure perspective, in the past, Hong Kong market is all about internet and also financial companies. All other sectors are too small, and we really don't have a lot of the hard technology companies. And now with these waves of IPOs, we now finally have some of these semiconductor companies, AI companies, robotic component companies, etc. And I would say that it actually makes Hong Kong market more representative of what the Chinese economy is really doing from a sector perspective. Anyway, I think we move on to the next question, because over the past 2 weeks, how you share some really important insights, in my view, about the China market. I think you mentioned that the Chinese economy may be getting closer to the peak in the current cycle, but the market valuations are still near the bottom of the range as you take into account the overall liquidity conditions. For the broader audience here of our podcast, could you walk us through the arguments in more detail? And I think more importantly, how will these thinkings affect the outlook of the Chinese market?
Yes, the quantitative economic cycle model that I developed to track the movement in the Chinese economy is one of the very important elements in my market calls, because market almost always reflect the direction of the economy. And so if we can tell where the economy is going, then, we should be able to tell where the market is going next, right? So that's why the model is very important. Now, I think a common misconception is that when the economic cycle reaches high, then there's no more gains to be had in the market, which is not exactly true. So two things can happen. One is that, once the economic cycle is reached, then the economic growth momentum is going to slow down, right? So because the model is actually measuring the momentum in the economy. Now, when the momentum slows down, then the market price tend to reflect that because the market is priced on margin. Then in this reflection process, then market price could be under some pressure, especially when there's catalysts, for example, interest rate hike or trade war or other risk factors that is in the market, then the market tend to be under pressure. Now, another thing is that even though the growth momentum is slowing on the margin and the market has reached a relatively high level, then the gain in the market can also slow, but not necessarily crash, right? So the market can go sideways for a certain period of time, or the market can surge further because there's plenty of liquidity in the system. So in this case, the market stopped reflecting the weakness in momentum in economic growth, but rather the liquidity growth momentum in the market price. Now, that's very, very important to recognize this possibility. In 2015, now what happened is that if you look at the chart, you can see the market actually rallied away from a weakening economic momentum. Now, that's how we define a bubble. Market price rally away from weakening momentum or weakening fundamental, and therefore it's called a bubble. So that was the situation in 2015. Now, what I'm trying to say is that even though we're probably going to detect a weakening momentum going forward, as we have already detected such happening in the past 2 months. Now, basically, in the first half of 2025, because of the national consumption subsidy and also Chinese exports has been going strong, I think the first half, the Chinese growth is actually beating expectation. Now, going into the second half, especially in the fourth quarter, then we're seeing consumption start to slow again. Property price continue to fall. Property sales continue to fall. Property investment is still down double digit. So the momentum is indeed slowing. But I think market rally away regardless. So I would say that whether it's a bubbly scenario or whether it's a scenario that calls for more policy support, one thing we can be sure is that in the first year of the new 5-year plan, it's highly unlikely that the authority is not going to use supportive policies to support the market and the economy. So I think more likely than not, we're going to see more supportive policies coming out in the twin sessions in March. If so, then I would say that, after this pause, especially after regulators get its hands on the market rising at a measured pace, then I would say that the market will resume its rally in the coming months.
Yeah, and we do have similar confidence in the Chinese market from Julius Baer as well. The last question from a lot of our investors is what are the sectors that we should pay attention to? Obviously, in a bull market, most of those sectors should rise, but if we have to pick a few, what would be your choice?
Yeah, I think we've been recommending precious metal, non-ferrous metal, and the resource sectors. I think they're doing very well, exceedingly well. It's well above our expectations, even though we have a very strong recommendation of these sectors and these names. I think secondly, we are getting the AI opportunities as well. So, we're getting exposure in the semiconductor industry and many of the AI related themes. For example, new energy generation and any companies, any sectors that is related to AI and technology development. Lastly, I would say that high dividend yield stocks, which is still paying 6-7% dividend yield in Hong Kong. I think this can be a longer term allocation as people's base portfolio allocation so that you continue to enjoy a 6-7% yield in a world that probably the Fed interest rate is going to be cut again. So 3 things: metals, AI, and tech, and also high dividend yield stocks.
Very well said. And thank you very much, Hao, for sharing. And that's pretty much all we have to discuss today. Ladies and gentlemen, thank you for listening and stay tuned for our next podcast. Goodbye and speak soon.
Thanks, Richard.
The information and opinions expressed in this podcast constitute marketing material and are not the result of independent financial or investment research. Please refer to www.juliusbaer.com/legal/podcasts for further other important legal information.